Okay, this is going to be the 1930s part one, the stock market crash. We'll be looking at the Great Depression, analyzing what weaknesses in the economy brought it about, and the how far we fell, what the psychological and emotional consequences of it were, and if I don't run completely out of time, although I may well punt this to the supplements are there for you. That's why I wrote them. What two different presidential administrations did without either one of them experiencing complete success in getting us past this economic collapse. Okay, the stock market crash. Well, what is the stock market? You may have heard of buying stocks or bonds. The umbrella term for these two things is securities. If you buy a bond from a corporation, you are lending the purchase price to the corporation. Over a period of time, the bond will mature, and then you can collect the face value, with the difference between the purchase price and the face value being the interest that you're paid. If you buy stock, you're buying a small percentage of ownership of a corporation. Stocks normally sell in blocks of 100, and they're traded on continuous auctions called stock exchanges. The main one in the United States, and probably still in the world, is the New York Stock Exchange, which dates from the 1790s. But there's a stock exchange in Chicago. There's a stock exchange in San Francisco, I think, Tokyo, London. There are stock exchanges around the world. Now, by the late 1800s, people who were, and generally it's well-to-do people who would do this. This is not a game for ordinary people most of the time. But if you could analyze the stock market, what it did, how it performed from one day to the next, to get that down to a figure you could wrap your mind around, then you'd be better informed. So one day in probably the 1880s, a man who was a part owner of a brokerage called Dow Jones. There were Dow Jones and another man whose name didn't look good on the letterhead, so I don't know what it was. He just made himself an informal little list of 30 or so of the main industrial firms whose stock was being traded in the market, and simply wrote down what price their common stock had closed at that day and just averaged it up. That was the original Dow Jones Industrial Average. Now, this started something big. It's no longer the only index. By the way, an index is not an average. It's technically an index. An index is a number used for comparison purposes. But there are 5 different Dow Jones average. They call them averages, even though they're indexes, in more recent times. Okay, that became an indicator of how the market was doing. By the 1920s, people are mistaking it as an indicator of how the economy at large was doing. Okay. In the mid 1920s, the Dow Jones Industrial Average began to rise significantly, and it, like a comet across the sky, it attracted the attention of larger and larger numbers of Americans. Articles were written about it. More and more people decided they would get in on it. The big rise began about 1928. Why did this happen? As far as I know, the most attractive among a number of theories, probably all of them are true to one degree or another, was European investors shifting their capital into the American market, which appeared to be far more stable than were stock markets in Europe, which was still struggling to recover economically from World War I. So new money comes into the market that bids the prices up. Now, you end up with, just to make a longer story short, with a kind of self-sustaining reaction. As prices rise, more new money is attracted into the market from foreign investors and from Americans, a lot of them from classes of people who had hardly even heard of the stock market before. The more new money comes in, the more the prices go up, and the more prices go up, the more new money comes in. and it eventually feeds on itself. So that by 1929, for 2/3 of that year, the market was outperforming all previous years. The value of stocks was grossly inflated. Okay, this is what's sometimes called a bubble. Bubbles do one thing, they pop. That's what's going to happen. Now, technically, what I mean by this, if a corporation has physical assets in the form of plant and equipment and vehicles, all that kind of thing, the total value of that should be approximately equivalent, factoring in their earning power, with the total price of all their common stock outstanding. You multiply the number of shares by the price, and that number should be somewhere in the same ballpark as the total physical assets of the corporation. What if it's way beyond that? That's unrealistic. Okay. So more and more people are getting involved because it looks easy. Now, there were some things feeding this. One particular one was something called buying on margin. Buying on margin. That is when you buy stock with borrowed money. Can you do it today? Well, yes, but at no more than a 10% margin. The margin is the percentage of the price of the stock that the lender provides. Okay, you make a down payment and you're paying for a certain percent of the value of the stock you intend to buy. The lender is going to provide the rest, and you owe the lender that much money. The interest rates were ferociously high on this. And in those days, with less regulation, banks could double as brokerages. So sometimes it's hard to tell the difference. Is it a brokerage or is it a bank? That was made illegal in 1930, and the law making it illegal was repealed some years ago. Okay. So we're going to run a couple of parallel transactions. We're going to make money the old-fashioned way, and we're going to make money the new-fashioned way with margin. Let's say you came into an inheritance, $1,000. All right, that's way more purchasing power then than it would be now. So you've heard all this about the stock market. So you call up a broker and he advises you to buy. We're going to make up a corporation here, ABC Petroleum. So you buy $1,000 worth of ABC Petroleum. Now I'm simplifying things here. I'm keeping the numbers easy, and we're just going to understand that you pay the broker a fee for buying that stock for you. Okay. So you got $1,000 worth of ABC Petroleum common stock. Stock market's rising all around, and ABC Petroleum stock goes up over a period of time by 50%. It's up to 15. Let's see, $1,000. You know what? Let's make it 10,000. You got $10,000, goes up to $15,000. That looks good to you. So you have the broker sell out, and until you deduct the broker's fees for handling a transaction, you've turned $10,000 into $15,000. That's roughly a 50% capital gain. A capital gain is the rise in the value of an asset, and that's extraordinary in itself. That ain't chopped liver. That's the old-fashioned way. Now let's try the new-fashioned way. You got your 10 grand, and the broker that you contact is maybe a bit more on the sleazy side, so he recommends a margin transaction. You're going to put your 10 grand down on the purchase of $100,000 worth of ABC Petroleum stock. Okay? Now, you owe the seller of the stock $90,000. That's more money than you and all your relatives put together at that time. But as long as the market continues to rise, you're going to be okay. Now, over whatever time period we did not specify, that stock goes up 50%. So your 100 grand is now worth 150 grand. You sell out, pay the interest and the brokerage fee, and then before you do that, you have not a 50% but a 500% capital gain, because you've turned 10 grand into, you get your 10 grand back and 50 grand more on top of that. Remember, I'm keeping it simple. A lot of people did this. A lot of people made money. The trick is to get in and get out. And the temptation is going up and up, just to hang on maybe a little too long. Now, what happens if the value of the stock drops, then you could be in trouble. Um, Remember, you owe a ferocious amount of money here. Now, if the value, the price of the stock that you borrowed, remember, the stock is the collateral for the loan. The stock is the collateral for the loan. If its price drops below the amount that you owe on it, all right, you owe 90 grand, but the price has dropped. Now that stock's only worth 80 grand. Okay, the lender can issue a margin call. In other words, they want you to pony up the difference between um, what what you owe them and what that stock is worth right now in cash. That alone could be ruinous. So that's the tightrope that you're walking. But as long as prices are going up, you had people taking out second mortgages on their houses, inheritances, cashing in insurance policies, their kids' college fund, whatever it was. You had corporate directors sneaking funds out of their corporations and playing the stock market on the side, hoping to, make a killing and get the money back where it's supposed to be before the auditors catch up with them. You could go to jail. So the margin transactions are feeding all this. In 1928 and 1929, which is referred to as the miracle year. Okay, it ain't going to last. On Friday before Labor Day weekend in 1929, the Dow Jones Industrial Average closed at a then all-time high, which would not be equaled again for 26 years until the year 1955. That number was 452. To put it in perspective, the Dow Jones Industrial Average today is in the 29,000 range. And by 1929, the formula was in place, which has not been changed since, to calculate for all kinds of eventualities, and the number is continuously comparable from the year 1927 down to the present day. Okay. After Labor Day weekend, the rise stopped and prices started trending downward on the New York Stock Exchange. In a face-to-face class, I would tell people in the class, show of hands, you don't know what's about to happen. Clear your mind of that. Prices are trending downward when before they were trending upward. What would you do? You got three choices. Either sell now, hang tough, which is what all the gurus are telling you. The market's fine. It's going to resume its meteoric rise as soon as it has found firmer footing. Or third option, buy more. And of course, they know it's going to crash, so they say, well, sell now. But some people are selling. That's why I hand out here, the market is doing this instead of this. Okay? If they'd all been selling, it would have been doing this instead. You kind of get the idea. So, and it's a matter of concern as the month of September went by. Then getting into October, it gets a lot more serious. What's happening this time is an increase in what is known as short sales or selling short. What is that? When you're about college age, about the age most of you are now, sooner or later, some well-intentioned grown-up is going to look you in the eye and say, don't sell yourself short. What they mean by that is don't underestimate your personal potential. That's good advice, but it has absolutely nothing to do with selling short on Wall Street in the stock market. Okay? Now, this may sound like a late night infomercial, but selling short is a shady technique, a dangerous technique, where if it works out, you can profit from a decline in the price of a stock. Interesting? Sound interesting? Let's just say don't try this at home, kids. And I'm a little bit not quite to the time of that. I'm going to tell you about selling short and how it ended tragically when we come back for the next part.